guys, this is Mike with Van Trading. I wanted to do a quick video for you guys. The market's kind of been in turmoil here a little bit, and I'm getting a lot of emails and questions about really what's going on, what investors should do, stuff like that. Okay. Put things in perspective. The SPY is only down 3% from its highs. The QQQs, they're a little bit worse. Big cap tech is down 8.5%. And the small caps are down 4.7%. So, things really, what we're in is a pullback here, guys. We're not in some kind of, major downtrend here. That's not what we believe. Of course, you always want to look at where your levels are, and this has not really been, it's been pretty orderly selling. Okay. What's been different is what's been different is what we've seen for the last, 3 months. The market character has changed. So I know for a lot of you, that's not been in the markets for a while. That's maybe a little disconcerting. But what we have going on here, guys, is just a market that's bringing stocks back into value. It started out in a rotational basis, and now it's becoming more of a value issue. Okay. And, it's not something to, if you have good trading rules, and you've been following your trading rules, and you've been, managing your levels, and you're managing your risk, then, look, we've had some good trading for the last couple of months. You made some good alpha, and now it's time to really, you're going to take a hit here a little bit here and there, try to manage around positions. But as long as you stick to your rules, things should be good. And I don't see this lasting much longer. I've been trading over 20 years in the market, and this has been an orderly pullback. It really hasn't been. We haven't seen extreme negative ticks. We haven't seen just bids being washed away, and traders just pulling the bids. It's been pretty orderly, and it's been an interesting market. So let's hit the charts here and kind of look a little bit more in depth with what we see in this marketplace. First off, on the SPY, like I said, SPY is only down 3% from the high. It's pretty much come down to its 50 moving average. We're kind of looking here. We were kind of using the playbook here of the last time we had this little bit of a pullback. Wouldn't even call it a pullback hardly. We hit the 50 moving average, and then we accelerated back out of there pretty quickly, and made new highs. Now, yesterday pretty much invalidated that playbook for us. We got pretty much weaker from the get-go and closed right on the lows and right at an important level. And we were gapping down a little bit this morning. So a little bit different from what we saw back at the end of January. So you got to obviously, as the market, you got to look at the levels. You got to look at what the market's giving you. And it looks like we're going to be in for a little bit more of a pullback here. Okay. Now, giving you an understanding of pullbacks, corrections, bear market. Pullbacks on average are about, they average 7%. A 5% drop is considered a pullback. And they typically happen 3 times a year. So this is something that's normal for a market. Typically, markets don't go straight up. They stair step up, and you have these pullbacks. And the key is to be able to trade around them. A typical pullback actually lasts a month, okay? I don't see this pullback really being that deep or lasting that long. But again, it's all going to be dependent upon this 50 moving average. If we can hold this 50 moving average, if we can kind of hold in here this level, this 378.46 level, then I think we can get some stabilization in there. But again, you got to watch your levels and watch price action. Correction. Now, correction, I get a lot of questions. What's the difference between a pullback and a correction? Well, correction is 10 to 15%. And on an average, about a correction is about 12%. Happens every 16 months, and it lasts about 3 to 4 months. Okay, and then obviously a bear market is anything of 20% or more. They happen every 7 years, and they last about 6 to 7 months. Okay, So here, like I said, SPY down 3%. QQQ's pretty much close to a correction. They have broken their 50. They have broken their long-standing trend line that we had from the breakout from the coronavirus dip. And they did make a new low. So this is, big cap tech heavily oversold. We're going to be looking to see if this 303.50 level holds. As far as small caps, it was interesting. Small caps are actually off 4.7 more than the SPY. I didn't think it would be because they're kind of holding up a little bit nicer in here. They're nowhere near their 50 moving average. They're nowhere near the low that they printed a couple days ago. So small caps kind of holding up, but they are off a little bit from their. This is considered a good little pullback for small cap tech and for the IWM. So still looking good there. Very orderly, not seeing some heavy selling, but again, a little bit different than we saw in the prior pullbacks from this ascent up from the November election. So we have our trend lines in place, and what you're going to want to look for, guys, is for us to put in some kind of low. And I'm looking for, what I look for is, drive down, make a new low, and then on increased volume, we kind of, surge back up and close close to, the highs of the previous bar. So going to be looking for that type of action. And then we're going to be looking for the same thing as dip buys. We're looking for that consolidative action. You're going to look at the market depth, the time in sales. You're going to look at level 2. You're going to see, are they supporting the bids a little bit more? Do you see iceberg sellers kind of falling away? And that's really the only way you're going to really clearly identify, whether or not we are able to start building ourselves out. Remember, don't try to catch a falling knife, okay? Being a professional trader in being consistently profitable is putting the odds in your favor, okay? And what that means is you got to stay true to the risk, okay? You got to stay true to risk, and you got to have your stops. You got to stop out. You got to take your lumps because they can get bigger. And what you don't want to be doing in this type of market is trying to catch a falling knife and trying to average down, because you could average down and the next thing you know, it keeps on going down, right? I mean, if you look at some of the SPACs that we've seen, I see people, buying at different levels, and you had people in this BTWN and it's up here, and then they're buying here and thinking they're averaging down, and then they're buying, then the market's going even down. GSAH, same thing here. People were buying in here thinking, okay, well, I'm going to average down $12, and now all of a sudden we're down almost below the moving the 200-day moving average. So stocks can drop a lot farther than you can stay solvent. So look, if we put in a low and we put in a base and we start coming out of it, then now professional traders that are used to understanding how to average down, then you can do some averaging down. But you don't want to be doing it now when the market is going down, when stocks are going down. So just be careful. We still believe in the fundamentals. The fundamentals are strong. We are reopening. We have the vaccine that's going to increasing its efficiency. We have the Fed still strong. We have stimulus. Oil is strong. Financials are strong. All are backbones of a strong uptrending market. But I know if you've only been trading for the last 6 months, you think stocks only go up, but this is a normal stock market reaction. It's actually kind of light as far as the type of typical stock market reaction that you would see. Couple of other issues that we're looking at. Look, there were warning signs to this, okay? And we kind of talked about, if you follow our show, if you follow our afternoon show, if you follow our videos, we talked about this a month ago. When Tesla came out and announced that, Musk came out, started pumping Bitcoin, announced that he was buying Bitcoin, and Tesla, the reaction in Tesla was, traders just, didn't care. You saw that momentum starting to fade off, right? And we talked about the FOMO with GameStop. We had these huge short squeezes that were just, incredible. When you start seeing, really out of the place market action like that, incredible FOMO, where it's bringing in lots and lots of retail traders that typically don't trade, that typically is a signal of, hey, you better be careful. At least that's how the professionals look at it. Because look, it's no secret that retail traders typically are the last to come in and they buy at the top, and then the professionals sell into the retail traders, and then the retail traders sell when it drops. They take their losses, and then when they're selling, then the professional traders are buying from them and taking it back up. So it's the old 80-20 principle. Okay, and it's nothing against retail traders. It's just it's just typically the way it works. So there was warning signs to this, but again, I don't buy into all this. This is not going to end well, right? Don't buy into that bullshit, because this is just a typical pullback. This isn't going to end well. Would we see incredible selling into the market? And we're not seeing that right now, right? We're seeing an orderly pullback, small caps, and we're still seeing really good strength. I mean, we're seeing it in the cruise lines. I mean, Carnival Cruise Lines, I've traded this all throughout this week. We've seen it in the airlines, right? With the jets and the rest of you had Spirit making new highs, and we see it in the banks. I mean, the XLF is at highs, as you would expect with rising rates. But the key is, guys, be careful trading into these stocks, right? Because if this pullback is going to last and go a little bit further and maybe even touch into a correction, then even those stocks will pull back. So I would be careful trading into those stocks from a rotational basis, because the market has changed. The key is, guys, as a professional trader, to be successful consistently, there's two things you need to be good at. Okay. One is you need to be good at identifying relationships that are important to the market, and you need to be able to identify when a market character changes. Okay. If you really want to be a good, consistently professional trader, the quicker you can identify those two things, the more the odds go in your favor, and the better you can trade. I mean, and we noticed it over the last 2 weeks that the character of the market changed, right? And the greatest arbiter to see whether your strategies are no longer working and the market character has changed is your P&L. Okay, it's been tougher tape, it's been tougher to trade, and so what you got to understand is what got you here isn't necessarily going to work in the market going forward. And that's why traders typically have different types of strategies for different types of markets. So this is something you got to understand. If you just started trading, you want to make sure you can identify what type of market you're in, and you can identify the relationships, right? The relationships. If you guys have been following us for a while, we believe in relationships a lot to give us an edge in the marketplace. And one of the things that we were using just even a couple months ago, we were using, Apple and Tesla as our market generals, right? We were looking at Bitcoin as one of our indicator relationships. And, we kind of switched that. And I had a viewer kind of come up to us, message us and say, Mike, man, I haven't heard you talk about Apple much. I haven't heard you talk really about Tesla. You're talking about rates now. You're talking about, other things. Well, that's because the market changed, right? And so what we did was we changed with it. So the relationships that were important was interest rates. So we pull up the TNX, right? We were pulled up, 10-year yields, and I'll show you the screen, and we were pretty much pulling these up for you guys way before. Let me see if I can get in here on the rate screen. There we go. So we were pulling up, talking about rates way before even the CNBC and other really channels were talking about it, because we saw that effect. We saw there was issues with liquidity in some of the pooling that we saw in some of the auctions that the Fed was having. So, rates are going up, and now the relationship is rates are an important relationship that we want to look at. And look, that relationship's always there. It's just that with different markets, different relationships come into view. And with the TNX, And long-term rates, it's something that the market cares about. It's in focus. So we have it on our charts. IWM, we've had on our charts because IWM is what has led us up from the January, from the lows, right? So, right, not January, excuse me, up from the November election. So IWM has led us up. So when we're having some weakness, I want the IWM on my screen because they're going to get us back out of this, right? And now I'm starting to look at the QQQs because the QQQs are leading us down. And if we start seeing some basing in the Qs, it may be a signal of maybe some type of bottom. Okay, so relationships are important. You always need to have, the market is always having different types of relationships to how it trades to give you an edge into the market. So make sure that you're looking at those relationships. Going forward, look, we're having a temporary issue. We're pulling back. Stocks are coming back to value. That's what the 50-day moving average is for. It's really what we call the value line. So stocks are kind of pulling back to that. And be careful of these reopening plays, because if we do go a little bit further and we do go have some more weakness, then you could see those stocks start to roll over too. Now, what we're looking for going forward, look for, like we talked about, reactionary lows, right? Does this IWM not make, because remember, they let us out, do they not make a lower low? Now, I kind of signaled this that, maybe this was a little bit of a different pullback because it did make a lower low here, which we typically didn't see in the IWM. So, again, they're kind of holding up kind of well. They're not close to their 50. Do they not make a new low down here? So that's something to look at. Do we get pulled out? Look for some basing, some kind of consolidation. Don't try to catch a falling knife. Don't average down. Okay. There's strategies of losing traders. You don't want to get caught up into that. And look at your market depth. Okay, that's when you're going to start seeing a change in character in the bids and the ask, volume, the depth, and how they're reacting. That's going to give you the very first, it's like if you're in a war and you're out on the battlefield, that's like being in the trenches. That's getting a view of what's going on in the trenches with the market makers, and you're going to see it there first. You're going to see that characteristic change. So make sure you understand level 2. Make sure you're looking at market depth, because that's going to give you a guide out. Now, going forward, again, we have reopening, the vaccine, the Fed. It's Thursday on March 4th. Jerome Powell was supposed to speak at 12 o'clock. I think you may see something from there. We got the stimulus that's going to be passed. You got OPEC meeting today. Oil is still strong. So, I don't see a complete breakdown here. But again, let price be your gauge, and make sure, guys, that you are watching your levels and using your stop losses, using your, what has gotten you here as a good trader to begin with. So again, normal action, just want to put this quick video together so to help you guide yourself, stay calm, keep emotion out of it, and trade well.